Investing in ETFs, comprehensive tips and strategies for long-term success. So make sure to watch the full video. Investing in exchange-traded funds, ETFs, has become increasingly popular among both seasoned and novice investors. With their ability to offer diversification, liquidity, and cost-effectiveness, ETFs have become an essential part of any investment portfolio. This comprehensive guide aims to provide readers with in-depth knowledge and practical tips on how to invest in ETFs successfully, helping them achieve their long-term financial goals. 7. Price average. We start with the simplest concept, the dollar cost average. Price averaging is a technique used to regularly purchase a fixed amount of an asset regardless of changes in the asset's price. Novice investors are usually young people who have been working for a year or two and have a stable income where they can invest some money each month. Such investors should put down a few $100s a month and not invest it in prime loans but in ETFs or groups thereof. Benefits. Regular investing for beginners has two advantages. The first is that it teaches the discipline of conservation. As many financial planners advise, it makes sense to pay yourself first, which you do by saving regularly. The second advantage is that by investing the same amount in the ETF each month, essentially the average price of the average, you collect more units when the price of the ETF is low and more units when the price of the ETF is less than 1 unit. So average your cost of ownership. This approach pays off handsomely over time as long as you maintain discipline. For example, let's say you invest $500 in the SPDR S&P 500 ETF, SPY, an ETF that tracks the S&P 500 index on the first day of each month from September 2012 to August 2015. In September 2012, $500 would get you 3.67 units, but 3 years later, when units approach $200, a $500 investment per month will get you 2.53 units. You have purchased a total of 103.79 SPY units over 3 years, based on the closing price adjusted for dividends and distributions. With a closing price of $209.42 on August 14, 2015, units are valued at $21,735, with an average annual return of approximately 13%. 6. Asset allocation. Asset allocation, which means allocating a portion of the portfolio to different assets such as stocks, bonds, commodities, and cash for diversification, is a powerfully capitalized tool. For most ETFs, the low investment makes it easier for beginners to use asset allocation strategies depending on their investment time and risk appetite. For example, young investors in their 20s will invest 100% in ETFs because of their long-term investment and high risk. But once they're in their 30s and embarking on major life changes, like starting a family and buying a home, they may move into non-ideal positions like 60% stock ETFs and 40% ETFs. 5. Swing trading. Swing trading is trading that aims to profit from large fluctuations in stocks or other instruments, such as currencies or stocks. It can take days to weeks for things to settle, unlike the daytime market where things are rarely open at night. The characteristics of market fluctuating ETFs are their diversification and competitive low-demand spreads. Also, because ETFs are available in many different investments and many industries, investors may choose to trade ETFs based on the market or asset class for which they have specific knowledge or experience. For example, someone with a background in tech ETFs like the Invesco QQQ ETF, QQQ, which tracks the NASDAQ 100 index. New traders following the stock market may want to trade with one of the many commodity ETFs available, such as the Invesco DB Commodity Index Monitoring Fund, DBC. Because ETFs are usually baskets of stocks or other assets, they may not appreciate at the same rate as individual stocks in a bull market. Likewise, their diversification also makes them less vulnerable to downturns than individual stocks. This provides some protection against capital erosion, which is important for beginners. 4. Trade rotation. The ETF also makes it easy for beginners to rotate trades based on various trading levels. For example, suppose an investor invests in the biotechnology sector through the iShares NASDAQ Biotechnology ETF, IBD. Investors will want to take advantage of this ETF and move into more defensive positions, such as the Consumer Essentials Selected Sector SPDR Fund, XLP. 3. Short selling. Short selling, the sale of a borrowed security or financial instrument, is usually a pretty risky endeavor for most investors, and not something most beginners should attempt. However, short selling through ETFs is preferable to shorting individual stocks because of the lower risk of a short squeeze. a trading scenario in which a security or commodity that has been heavily shorted spikes higher, as well as the significantly lower cost of borrowing, compared with the cost incurred in trying to short a stock with high short interest. These risk mitigation considerations are important to a beginner. Short selling through ETFs also enables a trader to take advantage of a broad investment theme. Thus, an advanced beginner, if such an oxymoron exists, who is familiar with the risks of shorting and wants to initiate a short position in the emerging markets, could do so through the iShares MSCI Emerging Markets ETF, EEM. However, note that beginners stay away from double-leveraged or triple-leveraged inverse ETFs, which seek results equal to twice or thrice the inverse of the one-day price change in an index, because of the significantly higher degree of risk inherent in these ETFs. 2. Betting on seasonal trends. ETFs are also good tools for beginners to capitalize on seasonal trends. Let's consider 2 well-known seasonal trends. The first one is called the sell in May and go away phenomenon. It refers to the fact that U.S. equities have historically underperformed over the 6-month May-October period, compared with the November-April period. The other seasonal trend is the tendency of gold to gain in September and October, thanks to strong demand from India ahead of the wedding season and the Diwali Festival of Lights, which typically falls between mid-October and mid-November. The broad market weakness trend can be exploited by shorting the SPDR S&P 500 ETF around the end of April or the beginning of May, and closing out the short position in late October, right after the market swoons typical of that month have occurred. A beginner can similarly take advantage of seasonal gold strength by buying units of a popular gold ETF, like the SPDR Gold Trust, GLD, in late summer and closing out the position after a couple of months. Note that seasonal trends do not always occur as predicted, and stop losses are generally recommended for such trading positions to cap the risk of large losses. 1. Hedging. Beginners may need to hedge the downside in a large portfolio, possibly a legacy portfolio. Suppose you take advantage of a large U portfolio. Blue chips in U.S. stocks are quickly paying off the downside risk in U.S. stocks. One solution is to buy options. However, since most beginners are not familiar with options trading, another idea is to take a short position in an ETF, such as the SPDR S&P 500 ETF or the SPDR Dow Jones ETF, Industrial Average ETF, DIA. If the market drops as expected, your blue chip business will be profitable because the loss of your data will be compensated by the increase in your short ETF work. Note that if the market goes up, your profit will be limited because your profit will be offset by the loss of your short ETF position. However, ETFs provide a simple and effective method of protection for beginners. What do you think of our video? Let me know in the comments section below. If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go. What do you think of our video? Let me know in the comments section below. If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go.